Hi guys, and welcome to Macro Markets, a show where we analyze how the macroeconomic news and events impact the crypto trading. I'm your host, Marcel Pechman, veteran stock markets and derivatives trader analyst at Cointelegraph. On today's Macro Market show, I'll explain why data on US consumer savings might be incorrect and debate the odds of the US government entering a shutdown by the end of the month. Today's show will start by discussing how the US families' economies are doing right now. According to the Barron's headline, US consumers are flush with cash. They don't feel that way. Americans mostly are crying in their beer. Numbers opinion polls show that most people think the economy is lousy, contrary to their own personal circumstances and all objective data. The consumer is in great shape, really, according to the title of a report from Mizuho Securities. While lots of attention is paid to the notion of dwindling excess savings, a nebulous concept at best, household wealth relative to the income has returned to close to its all-time highs between $400 billion and $1 trillion. So, rule number one in psychology, everything is relative. Maybe people are comparing their current situation with late 2021, when the S&P reached an all-time high and the housing market gained 20% year over year, and salaries, wages increased by 11% versus the previous year. I remember quite vividly because Bitcoin also reached an all-time high of $69,000 at that time. Now, fast forward 2 years later, and the price of everything has gone up, but getting a better job is more difficult or nearly impossible. So yes, overall, their situation might be good, meaning they have a job, they have some kind of savings, their mortgage is lower than the actual rate, but they feel, my situation 2 years prior in late 2021 was much better than the current one. So I'm unhappy. As for the concept of excess savings, I tend to agree with the Barron's author, since the savings of 80% of every US citizen is less than what is needed for 5 years of retirement, meaning they literally have no idea what will happen if they live up to 75 years old or longer. Odds are they'll have to continue working. They'll be forced to work for much later, much longer. And this trend is already in place. So when we think about excess savings, this concept really doesn't get through me. I mean, yes, you're saving for retirement, but first of all, you don't know how much is needed. Second most important thing is 80%, maybe 90% of the Americans don't have savings to retire for more than 5 years, which is absurd. So I don't think they have excess savings at all, if you think it true. Now, back to the article. Indeed, household wealth rose to a new peak in the second quarter, according to the latest Federal Reserve data, released this past week. Households' net worth increased by 5.5 trillion to 154 trillion in the period. So we're not talking about excess savings right now. We're talking about the household's net worth. So everything that composes the balance sheet of a family, that includes houses, even if it's not fully paid for. Mizuho found net household wealth relative to incomes is just below a record 400%. That largely reflects the appreciation of equities and real estate assets. Let's give an example to make things more clear. If a family has a combined annual net income of $100,000 gross, their household wealth on average is $400,000. Sure, there's also the debt that every US citizen loves so much, but that number is at 100% of their annual income according to the article, at a 20-year low, meaning on average each family has $100,000 of debt and $400,000 of assets. So why are the US consumer disappointed given that most have a mortgage interest rate well below the current levels? Well, the author of the Barron's article has the answer. Consumers seem more concerned about the prices that they pay for stuff than the values of what they own. Nothing seems to capture their attention as much as the cost of filling up their autos. US crude futures, so oil futures, are up nearly 10% in the past 2 weeks and up 30% from their 2023 lows. That follows Saudi Arabia's decision to extend its output curbs through the end of the year. Now, picture Biden saying, "Damn Saudis." The president has been selling the country's strategic reserve oil at the fastest rate ever, down from 640,000 barrels in October 2020 to the present 350,000 barrels. They know exactly how the US citizens get pissed off when the oil prices are too high, so that they have manipulated the metric to curb inflation. And so far, it has been working. Now, there are two problems with that strategy. First one is it can only last for another 2 years before the strategic reserve is completely depleted. Second, the big oil producers can monitor this data and cut production to push the prices up, which has been the case recently. So, for the next 12 months, Biden will have a tough job, given that inflation remains a big problem, regardless of it nearing 3%. That's because the majority of the US families' investments, namely the real estate and the S&P 500 index, will likely suffer if the Federal Reserve continues to raise interest rates. And what does that mean for Bitcoin? Well, let's be honest over here. If people have less disposable money, meaning the inflation is running higher than their income growth, or what the salaries are going up, it is certainly not good for cryptos. So in the first moment, whether it lasts 3 months or 18 months, Bitcoin will remain under pressure. Don't be fooled. No investor will seek shelter in Bitcoin if inflation goes back to 10%. At least not in the initial moments. Just to highlight, that's my own personal opinion, and it does not reflect Cointelegraph's official view. Now, let's move to the US budget problem. The CNBC headline reads, "Congress returns with the clock ticking. Overt government shutdown. Fund US disaster response." Again? Come on guys, another political debate that might lead to a shutdown? Nice! Let's see what is happening here. A deeply divided Congress returned Tuesday from a month-long summer vacation. Nice. With the clock ticking to pass spending legislation to avoid government shutdown. The US government will shut down at midnight on September 30 if Congress fails to pass spending legislation. Okay, it looks like a political issue, so something that can be fixed by handing out a few $1 billion here and there to support either side, right? No, apparently there's more behind it, as the article suggests. The House Freedom Caucus is trying to tie government funding to legislation that would crack down on undocumented immigration and restart construction of the border wall. Bank of America believes the shutdown is unlikely to last long if it does occur, given the political consequences for the Republicans and then the added pressure to fund the government given the devastating wildfires in Hawaii and the destruction from Hurricane Idalia in Florida. Interesting, at least. The world's biggest economy now depends on domestic tragedies to push funding bills. That kinda creates a perversive incentive, no? Or am I entering a conspiracy theory? Meaning, why prepare for disasters if dealing with them later means dozens of billions of emergency funds, which will be unlikely audited or scrutinized? The White House linked the disaster money to a request for more than $20 billion to back Kiev during its counter-offensive against the Russian invasion. Oh well, so not a conspiracy theory after all? Now they want to use a national disaster fund to cover the war bill. Who could have predicted that? Senator Scott accused the Biden administration of playing games by tying the Federal Emergency Agency, FEMA, funding to aid for Ukraine. Rubio told Fox News, "No matter how anybody feels about Ukraine funding, those two things should not be one for another." Now things start making more sense. The Biden administration is simply trying to find new pockets to dig for war money. Now it doesn't matter your political view or how supportive you are for Ukraine. It all boils down to the legal definition of the FEMA funds. And I'm not an expert on that, But as far as I'm concerned, it was designed to recover from disasters and build a more resilient nation. I know words are just words, and ultimately politics can do whatever they want as long as they have backing from the superior courts. Now, Biden's administration absolutely focused on increasing war funds at a time where two national disasters are in their early days, and it sounds like political suicide. But wait a minute, what do you think will happen to Bitcoin's price if a shutdown in the US government takes place? Most definitely a bull run, right? Smart money will make sure that typical hedge instruments such as gold and Bitcoin perform well, at least in the first moments, regardless of what will follow later or how long the government shutdown will last. I know it is a long shot right now, but make sure to write down this potential trigger for a crypto bull run by the end of September. Well, that's it for today. Hope you guys enjoyed the show. Remember to like and subscribe to the new Cointelegraph Marketing Research YouTube channel. See you!